Everybody's good to go. It's not only Julie and I sitting here. We've got guests, 3 guests online to discuss the issue of ESG. I think what's become apparent in today's discussion is how many of the panelists have brought up this issue of ESG, and it's clearly it's not only an emerging trend now, but it's become increasingly sophisticated, increasingly technical, increasingly tactical. It's quantifiable. So I don't think there's anybody who doubts the relevance of ESG, although one of our themes will be to question whether or not it is still, it's become a woke issue. But I'm going to, so the context of ESG is it's intricately linked to M&A. It's not really possible to conceive of an M&A activity that hasn't got a significant ESG component to it today. I mean, the one striking example for me, coming from Australia, was the AGL transaction, where the Atlassian funders of Atlassian, wealthy individuals, had motivated the AGL board to try engage in a takeover, and that was the first time in all my years of reporting on M&A that I've noticed that a shareholder focus was not the primary focus of a bidder's approach. It was an ESG. It was a clearly ESG laid out focus. Obviously, shareholders are part of that component, but the shareholders' concern there was not primary. So with that, I'm going to invite each of our panelists to introduce themselves, and then we'll get going. We'll take a few questions towards the end if Ed doesn't cut us off. Okay, so Julie, perhaps you'd like to introduce yourself.
Sure. My name is Julie Yoon. I'm Managing Director of Mintz Group in Hong Kong. We're a global due diligence and investigations firm, and we work with investor clients, corporations and law firms in the pre-transaction, during transaction, and post-transaction stages.
Thank you. Angus?
Thanks, Simon. Good afternoon, everyone, or good morning, as I think it still might be. Angus Booth, Senior Managing Director of M&A, Shareholder Engagement, Research and Campaigns for Morrow Sodali in APAC. For those not familiar with the Morrow Sodali business, we are a global shareholder engagement, proxy solicitation and ESG advisory business with 300 people globally operating in key capital markets. In APAC, that includes a presence in Hong Kong today, where we're represented by our country head, Raymond Chen, and Ivan Lee. In Seoul, Japan, and here in Sydney, where I am, unfortunately, and also a growing presence in Singapore. We're in a unique position to have overseen more than 140 billion of M&A deals in the APAC region over the past 18 months, and including here in Australia, close to 100% of the public market M&A deals, which is an incredibly fortunate position to be in, particularly from the perspective of understanding how global investors' attitudes and sentiment is evolving and changing towards transactions as well as activism, and how it's impacting their voting decision making. I suppose when you look at the culmination of all of the work that we do here in APAC across shareholder engagement, proxy solicitation, and ESG advisory, and the number of transactions that we've been involved in, be it M&A or activist situations. Our business is ranked now, and thank you to Mergermarket, but our business is ranked number 1 for global M&A advisory in proxy solicitation. And we're also the number 1 company side activism support company, thanks to Bloomberg. So two records that we're very proud of, given the quantum of work that we undertake in the APAC region.
Thanks. Erika?
Hi, good morning, and thank you, Simon and Mergermarket, for hosting. I am Erika Rodriguez, the Principal for Sustainable Investing and ESG, based in Hong Kong for KKR Asia Pacific. Some background on KKR: we are a global alternative asset management firm with approximately $496 billion US dollars of assets under management as of September this year. We sponsor investment funds that invest in private equity, credit, and real estate, and has strategic partnerships with hedge funds or that manage hedge funds. We have approximately 3,200 employees in 21 offices in 4 continents. And just some examples of our Asia Pacific portfolio companies include renewable energy platforms in India, Southeast Asia, and South Korea, namely Versant Renewable Energy Trust, Hero Future Energies, Serentrica Renewables, Aster Renewable Energy, and TACE, to hospital groups such as Metro Pacific Hospitals in the Philippines, to some of the largest waste management providers in India and South Korea, namely Resustainability and EcoOrbit. We have also invested in a leading real estate asset manager called KJRM out of our balance sheet, and this is one of the leading asset managers in Japan. My role is really to help oversee KKR's ESG integration process in Asia Pacific, making sure it aligns with our global processes. This includes everything from pre-investments, such as pre-screening and supporting ESG due diligence, to post-investment, such as engaging with companies on value creation and risk mitigation efforts. So thank you again, and hand it off to Ling.
Ling, there you are.
Thank you, Erika. Hi, Simon. Hi, everyone. I'm Ling from CDP China. I'm the country lead of capital markets in CDP, covering the mainland China, Hong Kong, and Taiwan. So CDP is a non-for-profit, and we started about 20 years ago, and the initial name is Carbon Disclosure Project. So it's very obvious what we are doing. We are environmental information disclosure platform, and urgently for climate-related information. And in the past 20 years, we expand our scope to other topics of environment, including water security, deforestation. And we are also looking at plastics, ocean, land use, biodiversity, etc. Going forward. So we are non-for-profit, and our model is quite investor-driven. So we cooperate with investors and utilize their power to get the disclosure from their investees and the potential investees. And we then provide information and data we collected from the corporates back to investors for the ESG investment decision making. And another route is a supply chain route. Basically, we use the power of the purchasers.
Okay, I think Ling's just gone off for a minute, but I thought, with all those introductions, thank you. I'm going to start off perhaps with Angus, just inviting the panelists to talk about how the ESG discussion has evolved as it relates to M&A as an introductory discussion point. Angus.
Thanks, Simon. I think the point here is that ESG investing is by no means dead, nor is it going away. And I think it's the ESG investing that is driving and perhaps evolving the conversation as we once knew it. If you look at the most recent data coming from Morningstar, there was about 120 billion of inflows into ESG investment funds in the first half of FY22, albeit that was down on the same period last year by about, it was about a third of the inflows from a year earlier. But it compares to the net outflows of about $140 billion from broader market funds. So clearly ESG investing is here to stay, but I think it's changing. The ESG issues that we're seeing are becoming much more important for longer term investors. Today, they seek to analyse material issues such as board competence, climate risk, or even cybersecurity has become a real issue, particularly here in Australia recently with some issues with organisations like Optus and Medibank. and it's being assessed to look at the impact on financial value, be it in a positive or negative way. And I think this is becoming far more sophisticated in an M&A transaction, where in the past we saw on an M&A deal that there was focus on people integration and culture. Today, we're seeing bidders ask the question around what are the climate risks and how does that potentially impact the longer term value. I think as a result of the level of investment that we're seeing coming from ESG conscious funds, it's impacting or having a greater consideration when voting. And we, 12 months ago, undertook a survey of about 29 funds representing $29 trillion of assets under management. And on the question of, relative to last year, keeping in mind that this was during COVID, have ESG risks and opportunities been given more focus in your firm when engaging, taking investment decisions and voting at AGMs, for instance? The overwhelming response on all of those three measures was 85% and above. So, it's becoming more apparent, both in the lead up to and during COVID, that investors are focusing more on companies' resilience to withstand events like COVID, where they're focusing now more on and asking questions around supply chains, human resources, and business continuity planning. The key drivers, for ESG, for the increased ESG focus, come back to a link to financial performance, followed by legislative changes, and we've seen a lot of that in Singapore recently, but also a client focus. And for us, this is really interesting in terms of the work that we're undertaking, particularly here in Australia, which is a full disclosure.
Have we lost Angus? All right, sorry about that. Erika, maybe you'd like to help Angus out there. if you can come in and then...
Yeah, can you hear me?
We can hear you.
Okay. I think Angus had some great points, and I'm kind of just going to... He ended at the legislative drivers, so maybe I'll go from there. I believe in the past 12 months, there's been a real focus on, first, avoiding greenwashing, and second, to help mitigate this, is creating a common language on ESG. So I'll give 4 examples that help support this from a regulatory standpoint, just building on what Angus was talking about. So first, in November of last year, IOSCO, which is the Association of Organizations that Regulate Securities and Futures Markets, published recommendations for regulators and asset managers that helped codify greenwashing for the financial markets, which is the practice of misrepresenting climate-related practices. The second, in June of this year, the 2 largest sustainable investing economies, EU and China, published 72 climate mitigation activities that are recognized by both markets. So this includes everything from manufacture of energy efficiency equipment to renewable electricity generation from solar and wind. The third, globally, the International Sustainability Standards Boards, otherwise known as ISSB, is set to deliver a global baseline set of ESG standards. The ISSB is a standard-setting board under the IFRS, which also oversees the International Accounting Standards Boards that develop the International Financial Reporting Standards. And lastly, fourth, as Angus was mentioning, closer to home in Asia, regulators and exchanges in Singapore, Hong Kong, and Malaysia are recommending financial institutions to align their disclosures with the International Framework Task Force on Climate-Related Financial Disclosures, TCFD. And kind of just building on what Angus was saying, there's really 5 main areas of focus beyond E that I'm seeing. The first is a focus on ESG disclosure and transparency, really to avoid greenwashing. Second is corporate governance. Third is diversity, equity, and inclusion. Fourth, and Angus was talking about this, is data responsibility or cybersecurity. And lastly, climate. And on the point of climate, as most of you know, many governments, such as China, has and companies have net zero emission goals. And then lastly, before I wrap up, just anecdotally, how I've seen the market interpret this is some investors are asking for more detail than just what is your firm-wide sustainable or responsible investment policies, to more detail on how you actually integrate ESG considerations as part of the investment lifecycle. So from pre-diligence to post-investment with very strong case studies. And increasingly, there is acceptance that good management of ESG is a value creation lever and enhances exit valuation. So a survey published by Edelman last year demonstrated that 92% of investors agree that companies with strong ESG performance deserve premium valuations of share prices. So thank you. Hopefully that helps kind of bring some strong proof points to how ESG is evolving in the M&A market.
Thanks, Erika. Angus, are you online?
I'm here. Can you hear me?
Yes, I can. Would you like to complete your
well, look,
those points you were making?
Yeah, look, and just to pick up on one of the points that Erika was making there around particularly some of the regulatory changes that are happening now across particularly in Asian markets like Singapore, Hong Kong, Malaysia. What's going to be very interesting to see is the flow of capital that comes into these markets from offshore investors, particularly those that are more ESG conscious, and the impact that's going to have on companies' response in terms of how they're reporting on climate, how they're aligning with and integrating TCFD reporting, because I think what you will see is for those companies that embrace it, it will be very positive. For those companies that don't see the benefits or that take time to get there, I think what you will start to see, and we've already seen this happening in some markets across the region, is that it will drive activism. And we've always known activism, particularly on governance-related issues, but I think in our US business, we are starting to see activism on the rise for environmental-related matters. And I think that will start to occur, particularly in some of those markets that are looking to improve and enhance their sustainability disclosures. But just the last point is just on your comment around AGL, and what we've started to see is the rise of the ESG conscious retail investor. And we saw it in the instance of AGL, and we might talk about that later on, but it was a confluence this year here in the Australian market where you had the proposed AGL demerger as well as a federal government election being battled out on environmental grounds and which party or candidates had the best environmental policies. And what we've started to see in this market is a greater consideration from retail investors when considering voting, be it at an AGM or in an M&A transaction, on ESG grounds. And it's not just millennials that are driving that change, but it's right across the board, and in particular, older shareholders as well, who in this market, as you would know, Simon, tend to be more conservative. But their views are changing, and I think that is seen now right up and down the investment chain, be it whether it's a ESG institutional investor or a mum and dad investor.
Interesting, thank you. Julie, at least you won't be disrupted.
Right. So there's a lot of talk of regulatory developments, and I hate to bore you with more. There are a couple more things that I wanted to hit on, and adding to what Angus and Erika said. So the SEC has a couple of rules in the last year. One was disclosing climate-related risk and metrics, and that was the most significant undertaking in more than a decade. It was to address investors' demand for standardized climate-related metrics and report for consistent, comparable, and decision-useful information. There's so many standards out there. I think there are many companies that are confused as to what standards to do, to use, what to measure. It would require registrars to disclose any material changes to these disclosures on a quarterly basis, which highlights the need for ongoing monitoring. Another rule was on human capital management, and Erika, talked about the DEI lines. And according to clients, companies are not prepared to answer SEC-type questions on diversity, equity, and inclusion. They're just not there. And this is actually seen as more significant than climate rules because it has more immediate impact. One other thing that I wanted to highlight is the recent EU directive on corporate sustainability reporting. And we're following this closely because we really believe virtually all businesses, with significant business footprint in Asia are going to be affected. And it's because of the extraterritorial effect. Non-EU companies that meet applicable turnover criteria in the EU will fall within the scope, even if they do not have physical presence in the EU. So this will have significant implications for multinationals in the US, in the UK, and Asia that meet this turnover test. So what we recommend is companies start carrying out near-term human rights due diligence and take proportionate countermeasures because these measures are coming. Another human rights environmental due diligence, the requirements would have to cover entire supply chains throughout the value chain. So this adds further complexity to the supply chain risk assessment and ongoing risk management. It also requires integrating human rights into group policies and strategic planning processes. So to prepare for this, companies will have to review supply chain and key vendor footprints in a more proactive approach. So these are some of the things I think that have started discussion, and I've also talked with some companies, one recently being a European bank, and they are, the issue of ESG dead is very far from dead. They are deploying a lot of resources. They've moved up their net zero target from 2050, which is recommended by the UN, to 2030. And they are investing 220 billion euros by 2030 on ESG and meeting net zero targets. They're also helping their clients transition to be more green, and they're not accepting any more clients who are in the oil business, for instance. They're helping clients in the oil business transition. So companies are actually really making big headways. They're making big commitments. They're not just doing lip service anymore. They are putting the money where their mouth is.
Perhaps if I can just pick up on the point there, particularly around, is ESG dead? I think I'd have to agree. It's far from dead. And in that same survey that I mentioned before, where we went out and spoke to global fund managers who controlled 29 trillion of assets under management, the number one engagement priority for them was climate risk. And so I wonder whether the question is more so, not so much is ESG dead, but do we need to refresh our thinking around what ESG is, particularly given now it's becoming far more integrated in terms of companies' strategy, and we're seeing that with TCFD reporting. ESG once sat out on the side. Now it's very much at the core of particularly Western organisations' approaches to strategy, particularly. And I think that will become far more prominent for companies in markets like Hong Kong, which, fair to say, is pretty advanced given it is facing into the US regularly, but in markets like Singapore and Malaysia. And as I touched on before, we are seeing activism, particularly on environmental related matters, start to rise significantly in the US, whereas on the S and the G, it's remaining relatively static. So I think that's a good determinant for potentially what is coming towards other markets globally.
Thanks. Before we get onto this, develop that concept of whether or not ESG is dead, I just want to ask Ling, for his observations on how the ESG's debate's evolving, and then I think that was very interesting, Angus. We will go back to that if Ling's online.
Yeah, thank you, Simon. So, hear me?
Yes.
Okay, cool. So, I think I just have some sense from the disclosure perspective. So, as mentioned that by Eric, TCFD and ISSB. So the latest, so we still think climate change is the sit in the center of the E element of ESG, and so we have seen there are more than 4,000 companies around the world supporting TCFD, starting from the first version in 2017. So in TCFD, companies are required to do scenario analysis to assess the transition risk and the physical risk from climate change on the revenue and the cost related metrics. So the users of the data can assess the climate impact on the company value. I think that has some implication in investment in M&A. And on the ISSB, actually this new organization starting from last November consolidate several standard setters previously on the market, including CDSB and Value Reporting Foundation. And the new drafting standards are quite based on TCFD's recommended framework. And so the two prototypes they have released earlier this year for consultation are the general sustainability reporting requirements and the climate-related requirements. So I think which is still quite focused on the climate change, and I think the big picture is that the standards are becoming more aligned with each other, and again, ISSB and TCFD's recommendation or framework are quite focused on the company value, which is the single materiality, and the European Union goes a step forward, and in the environmental in the corporate sustainability reporting standards, ESRS, they are looking at this double materiality, which goes beyond the perspective of the company value, but also the company actions on the company impact on people and planet. So which is also a perspective taken by the GRI, the Global Reporting Initiative. So we also see that ISB has reached some agreement with GRI to make the standards more aligned with each other and to reduce the reporting standards of the corporates. So that's some discoveries from CDP's perspective. Yeah.
Thanks, Ling. But to come back to Angus's point, maybe just put it another way: is ESG becoming too woke? Erika, is it encountering problems around greenwashing, around complicated asset mix, dare I say, with Ukrainian assets, maybe perhaps that might even involve Chinese assets, given the current investor climates. Colleagues at other asset managers are talking about concerns about going woke. We've seen legislation in Texas and other US, or proposed legislation in those American states outlawing certain investor concepts in the other way of ESG. So is it becoming woke, Erika? Is it dead, or is it alive and well and kicking?
So I'll agree with the rest of the panel. That's alive and kicking. So no, it's not dead, especially as Angus was saying, if you reframe it. And then at KKR, we've always approached ESG as, understanding that if companies carefully manage ESG and stakeholder risk and opportunity today, they should be better positioned in the future as diminishing resources, changing consumer demands, evolving norms, and increased regulation are expected. So some of the root causes of the sentiment, which you were spot on, energy security issues at the EU, several high-profile greenwashing cases where managers came under regulatory scrutiny for not following ESG-related processes that they promoted, recently came about. But again, for us at KKR, more than 4 decades of investing has really taught us that we are better investors if we manage ESG issues thoughtfully as part of our investment process. So our approach has always been about value creation and value protection, and we do this by identifying business-relevant material topics where we can create value or mitigate risk. And this augments our goal to achieving strong risk-adjusted returns for our investors. So we believe thoughtful management of material ESG issues is smart business, and we see it as an essential way to help portfolio companies' long-term success and an important part of our broader value creation toolkit. So I'll just give 2 examples of how we've done this. One from the environmental standpoint. For example, management of a company's environmental footprint can help avoid fines, improve operational efficiency, and minimize input costs. Since 2008, we have worked with over 60 portfolio companies on climate-related topics. When we launched our KKR Green Solutions platform in collaboration with an NGO, the Environmental Defense Fund, to support operational improvements. The second, social. Fostering a culture of ownership can really help create a more engaged and motivated workforce, thereby boosting productivity. So a strong example of this is when we acquired Chi Doors in 2015. So they're a leader in the garage door market. This summer, we sold Chi to a steel company, and throughout our ownership, really made 2 significant improvements in engaging employees. The first is from day one, we made all 800 employees owners at no cost to them. And when we sold the company, employees received a substantial cash payout on an average approximately $175,000 US dollars on equity on their company. And then the second is we invested in the employees and gave them a voice. $100 million per year was allocated to enhancing their work environment with decisions made by the workforce. So, small things like adding air conditioning, creating a cafeteria with healthy food options, but that can really boost productivity, especially if it matters to the workforce. We also invested significantly in safety initiatives, and the impact was substantial. A key safety metric called the total reportable incident rate went down by 58%. Employee engagement went up significantly. The EBITDA margin went from 21 to 35%. Revenue grew organically by nearly 120%. And KKR and its investors are earning 10 times the equity invested since 2015.
Interesting. Julie.
On the ESG is dead. Are we still on that topic?
Carry on, yes.
Yes, no. So as I said earlier, I don't believe that. I don't believe that ESG is dead. Like I said, I think there are varying levels of adoption and implementation depending on the region. Obviously, the EU and US is at the forefront. I think Asian countries are following, maybe more slowly and at uneven levels, but it will eventually have to follow. And
is it part of the mic? Is it working? There we are. So we did have problems, even though we're not online.
Yes. Okay. And, just going back to that, European bank that I mentioned earlier, they actually called it the ESG Tsunami. That it is to come. It is happening. It's just a matter of when. So the earlier that companies can adopt and start implementing, putting together transition plans, I think they'll be better off, and they would actually also, it would be less costly. They would have access to cheaper financing as well.
Thanks. Ling, to get back to you, is ESG dead or woke? Too woke? Perhaps not dead yet.
Yeah, of course not. So yeah, some data from CDP's perspective. So we have more than 18,700 corporates reporting to CDP in 2022, which is 42% from the last year. And it accounts for the more than half of the global capitalism. So, in terms of the investor-driven disclosure, we have more than 5,000. Among the more than 18,000 companies, we have more than 5,000 companies disclosed to investors, which is 47% of increase from last year. So we witnessed the largest increase of disclosing numbers on CDP. So at least from our perspective, at least the climate change disclosure, the E element, at least in the ESG, is very attracting a lot of attention and from across the world.
Thank
you, Simon.
Thank you. Angus, before we move on to a due diligence component, would you like to add to that? To what you were saying earlier?
I'd just say that, I don't think ESG is too woke for private equity, for companies like KKR or investors like KKR, and particularly Brookfield and Washington-based EIG, who we've seen propose a takeover or take private for Origin Energy here in Australia, and I think who's a large retailer, energy retailer. I think what you will see over the next 6 to 12 months is private equity play a big role in investing in companies that are high emitters, who are struggling to reduce their business strategy and their emissions whilst as publicly traded companies. And I think private equity has a huge role to play in helping companies and countries transition and lower their emissions output. So I think we would expect to see private equity play a bigger role going forward in helping some of these larger emitters transition to lower carbon footprints and strategies. And I think that's more easily done out of the public realm and allows them, to Erika's point, to enhance their own portfolio companies and the investments within those.
Thank you. I'm aware that time's moving on. We've only got 7 odd minutes. I wanted to shift the discussion a bit, Julie, starting with this concept of due diligence and how that affects M&A, or how M&A is affected by due diligence, and just if you could provide a few observations around your work on that.
Sure. I'll talk in the context of ESG in particular and M&A. So companies have been doing due diligence in ESG matters, for a very long time. It was just more on an ad hoc basis and more reactive as opposed to ESG context. Sometimes, clients would come and ask us to include some ESG aspects in the pre-deal, standard due diligence. But it tends to be more on an ad hoc as specific issues arise. But the issues remain the same. For instance, in the social, the S part of the ESG, reputational risk, relate to human rights, for instance. Forced labor, child labor, working conditions in supply chains or in the acquisition target. And reputations of brands, could be affected virtually overnight, with bad press, with social media, boycotts by consumers. So reputational risks were a big driver for such due diligence. What we see, going forward is that potentially it would be much more in a proactive approach and informalized. But most lawyers that we have spoken with, corporate lawyers, have said that they do not expect ESG to hold up deals. So, at the moment, a light touch would suffice, but it would be more important to integrate ESG issues to, post-transaction integration process, for especially if you have milestones and targets on key ESG specific issues. And also there will be serious implications for the supply chain industry. We see examples of blind spots are raw materials and labor force. There must be site visits so that you see what is really going on the ground. And to have the ability to deploy people on the ground is crucial. And for countries that don't allow, for site visits, there'll have to be certification, authentication somehow, not just the first tier, but second and third tier. So a lot of legwork is going to be needed to certify, supply chains. And most companies, to be honest, only really look at the first tier, maybe second tier, so they will have to go a lot deeper. Companies are asking more and more about Scope 3 emissions. These are emissions from activities of assets that are not owned or controlled by the reporting organization. So these can be upstream or downstream activities, include investments, leased assets, activities related to distribution, transportation. And many private clients, they say, oh, well, we don't have to worry about this. But if they are part of or end up being part of a supply chain, they will have to provide data. Another point I wanted to make that we've heard also from clients is that, rating agencies sometimes look at the wrong information, and they don't necessarily do all their due diligence. And so they would have to fight for to change the scores on the rating. So what we recommend is for companies to look at the scores for any discrepancies and dispute them. Granted with providing evidence and data to support your claim. And what people are saying is that there's no model or standardization which is leading to the problem.
Thank you. We've got 3 minutes for some questions, or otherwise, if there are no questions, I'll ask Erika to add to that discussion on diligence. But I think, Erika, if you don't mind, let's see if there are questions first.
Maybe 5 years ago, 10 years ago, an ESG deal may have been divest a coal asset, buy a renewable asset or company. I'm getting the impression that's not how you would define an ESG-themed deal these days. I mean, could you perhaps just to put some perspective, maybe could somebody sort of offer a slightly more up-to-date version of the range of what might be described as an ESG investment? Something it's not coal, selling coal, buying solar panels, but it might be...
Erika, did you hear that? No?
Unfortunately, I did not.
Did anybody hear that, or should we just ask Julie?
Well, I think Erika is probably much better.
They shouldn't hear the question.
Sorry, I didn't hear
well,
it,
I'll ask you
actually.
again. Erika, can you hear me?
No, Erika didn't hear the question.
You can hear me. I was just asking, maybe a few years ago, selling a coal asset, buying a solar panel business might be a classic example of an ESG deal. Just trying to spell it out very obviously. What's a different example of an ESG deal or investment these days beyond, say, just purely acquiring a renewables?
Yeah, so no, good question. And I think I've got 1 minute, so I'll try to respond quickly. I think there's also, just to clarify terminology. So first, when we talk about ESG integration, at least for KKR, this is the thoughtful consideration of ESG issues and relevant risks and opportunities across investment lifecycle, right? So from pre-investment, due diligence, investment committee to post-investment monitoring, managing. The second is, I think, what you're talking about more about sustainable investing. And we see this as an umbrella term that includes multiple approaches to being responsible investors. So from ESG integration to some of what you're saying that I hear is thematic and impact investing. And with KKR since 2010, we've invested $25 billion in climate and environmental sustainability investments. Also, to your question, it was kind of in my earlier point that there is a common taxonomy to exactly what is a sustainable investment. So the EU has the Sustainable Financial SFDR, right? And sorry, I'm seeing the clock go down. So another example to answer your question from our Impact Foundation recently is we partnered with Advanta, and it's a seed growing company, and that's really to help promote more seeds in the market, as well as just ensuring that we're addressing some of the supply chain issues that Julie was talking about, and also providing more livelihood. Hopefully that's a good example. And with that, I've got, I think, negative 20 minutes on the clock. Or 20 seconds, sorry.
Ed, should we take another question, or you want to close it? Okay. All right, well, I've got my instructions, but thank you very much to Angus and Julie, and Erika, Ling, even though we can't see some of you. Hopefully the flow wasn't too disruptive to everybody, but I believe it was a really interesting discussion with a lot of take-home points. Yeah, so thank you everybody for partaking.
Thank you very much.